Thank you, Warwick, and thank you everyone for taking the time to listen to our story. I'm going to start with, just for those of you who don't know a lot about Tyme, a brief recap about who we are and what we do, share with you an update on where we are in the business. And since I'm sure we've got a lot of avid analysts on the call, I've got some interesting statistics to share on what's going on in the under the engine under the hood of the business. So, you know, at Tyme, we design, build, and operate digital banks. And the business was shaped by the conviction that we are able to contribute to unlocking human potential in emerging markets by deepening and widening economic participation for consumers as well as for small businesses. The thing that is most unique about our business is that we have focused since we started 3 years back on bridging the digital divide in emerging markets through taking customers on a journey from the physical retail environment into the digital world. And I'll share a little bit more about that as we go. Now, Warwick, one of the fun thing about our business is that the tides and the flow of history has really been on our side lately. Whether it is the pace of digital adoption, whether it is the pace of regulatory change to support digital banking models, or whether it's the pace of technological development, whether it's on cloud computing or a digital KYC, all these trends are really conspiring to actually support a acceleration of digital banking trends. I'll just sort of point to one stat on this slide, and that's that last one that says we've seen in the last year 93 new significant new regulations in our markets to support digital banking and digital adoption by customers. Just a recap of the arena in which we operate, in which we play, and it's one with enormous potential. Tyme is headquartered in Singapore, and we've built our engineering hub in Ho Chi Minh City. So we employ about 300 designers, developers, and engineers in Ho Chi Minh City, where we currently hold the position of number 5, and then the 5th most popular tech investor in the country, competing against giants like Grab, Gojek, and the like, who are also operating there. Our flagship deployment, as you know, is TymeBank South Africa, where we launched a bit more than 3 years ago in February 2019, and where we hold a general commercial banking license. We got our 2nd banking license last year in the Philippines, where today we just passed the final inspection from the BSP, the regulator there, to start a bank, which means that we'll actually be launching in September and October this year in the Philippines. And then we've picked as our 3rd market Pakistan, where we've applied for a banking license. There are 20 applicants in Pakistan for 5 banking licenses, and we're optimistic that we will be one of the 5 winners in that market, which means all in all, we've got a very significant opportunity here in our 3 markets that we're looking at. We're talking about an addressable market of about 200 million people, a total population of almost 400 million people. And as you can see from the statistics there, significantly underserved, chronically underserved consumers and small businesses with young populations and great smartphone adoption. So that's the prize that we are playing for in Tyme. Warwick, what I'm going to do now is just put up a quick score sheet from where we are at the moment. and just talk about our immediate challenges in the next year, or our immediate priorities. So from a score sheet perspective, this month we'll be at 5 million customers in the South African business, of which that's sort of trending up 65 to 69% are active on a 30-day rolling basis. And we only count a customer as active if we've actually earned fees or income from them in the last 30 days. Our Net Promoter Score, the last benchmark one, was at 53. And in three of the last 4 measures, we had the #1 Net Promoter Score in the country. I've just seen the flash report on the next one that is significantly up from that 53. And the reason we're excited about Net Promoter Score, particularly in South African banking, it's highly predictive of market share movements. So the Net Promoter Score is a measure we're watching very carefully. Then we're progressing well with our distribution. Some of you might have seen we've launched our Buy Now, Pay Later product More Time at the end of last year. We now have over 950 different retail brands where one can use More Time. And it's still early days, but quite excited about the potential of that product. Revenue momentum is strong. We'll give a bit more detail later, but we're currently running at an annualized run rate of about $45 million, call it around 700 million rand of revenues a year. And our job is really threefold now in the business. By far, our highest priority is to get South Africa to profitability in the next year. So that's the #1 priority. The #2 priority is to launch TymeBank in the Philippines, and the #3 priority is to get a banking license in Pakistan. So that's the job that we have ahead of us. Now, I just want to quickly recap our recipe for success, or sort of our theory for success in banking. And you see here sort of this sort of infinity curve that we're illustrating here, that we think that sort of the success in our business is really a function of 5 sort of interrelated building blocks. Starting with structural cost advantage. It's quite a boring building block to start with, is low cost, but we believe that that is the key starting point for building great value for money products for customers, driving engagement, which in turn drives revenue, which puts us in a position to build real scale, economies of scale, both in countries and across countries. Warwick, I'm just going to quickly jump through and each one of these, and just sort of hopefully touch on sort of the core aspect of the design that allows us to do well in these 5 aspects. Now, if you remember nothing else about this chat, this slide is maybe the most important slide to remember. On the right there is version 5, or sort of the 5th generation of our digital kiosk that we deploy inside retail environments. And we've been designing and assembling these ourselves up to now. This is the first one that we actually now have assembled in Taiwan for shipping to the Philippines and to our deployment with TFG with the Foschini Group in South Africa in the coming months. And the reason this kiosk is critical is that this has become the key to us sort of bridging this digital divide through partnership with retailers. Of our 5 million customers, 80% of our customers have come to us through this kiosk, although the other 20% through downloading an app or going on web. But what this allows us to do is to take customers on a journey through the physical retail environment, where they can open a bank account in less than 5 minutes in a retail store. The other day, I watched a woman open an account end to end and get a debit card with her name on, personalized debit card in her hand, in 2.5 minutes. Warwick, admittedly, she didn't read the terms and conditions. She just clicked through everything. But I think that is one of the most efficient account opening processes in the world. We then attempt to drive our customers to activate their accounts through putting money into the account at the cash register inside the retail store. And from there, we integrate into the retail experience, the shopping experience, through loyalty points and other behavioral nudges, including our buy now, pay later product, which allows a customer to get short-term credit inside the retail environment. Right now, we've got about 850 of these kiosks deployed. Once we fully deployed in the Foschini group in September, we'll have 1,450 kiosks deployed, which means that in South Africa, we will have by far the most places where a customer can come and open a bank account, replace a card, and get basic banking services done. The other thing I'll just mention on this is that does not mean that we're not also continuously building the pure digital experience. We think that's a great customer segment. Those are people who are completely digitally native, want an end-to-end digital experience. And we're currently seeing about 60% of our online customers and our app customers coming to us organically, in other words, without us having to market to them. And we think that is, to some extent, a function of the fact that we've got this sort of physical presence as well in the market. The second aspect is really around product innovation. And Warwick, we can always come back and sort of talk about the products in more detail. But just here to mention again, we are very much transaction and savings led. That is our first product that we've brought to market. Then we've got these high frequency lending products, More Time and Time Advance, which is a earned wage product that we have in the market. Personal loans for us is not a lead product. We think it is an important product to expand over time. Credit card, and then we have currently 4 insurance products in the market. One of them, Time Health, is a very innovative and very cost-effective health insurance product. But more important here than the product is the underlying capability. And if in the previous slide, I described what is most unique about us, which is that physical distribution aspect. I think if there's any secret weapon or any superpower in the business, it's the one that we have on the right of this slide. And that is our ability to continuously rebuild and evolve the products and services and functionality that we give our customers. Our Vietnam team does on average 70 code drops in production per week. Now, this is by far not the best in the world. We admire people like Nubank in Brazil, who does, 5 times that. But this kind of, and we think we can do better as we evolve. But this ability to evolve the proposition for us, we believe in the long term, is key to retaining competitive advantage. Which brings me to the third element, which is the pace of growth in the business. And really the way we think about exponential growth, it's the number of customers times the intensity of engagement that gives us the pace of growth. So you see in the bars here on the screen, you see the active customer numbers and how they've grown. But at the bottom there, you see the 30-day activity rate, which started in the early days at 39% and now sort of grown to almost 70%. And we believe that activity rate is a function of both how customers become more comfortable with the platform, build trust in us, but also the richness of the functionality we put onto the platform. And so you'll see, I won't go through the detail, but on the flags there, you'll see the sort of how we've constantly added and enriched functionality over the last 3 years, which means that both the transactions and the unique use cases per customer have gone up substantially. So what you see here is the vintage overlay. On the left, number of transactions, and on the right, number of unique use cases. And you'll see from the light ones in the back to the dark ones in the front that you've got this trend for each vintage, typically starting at about, in the early days, about 3 or 4 transactions a month. Now the vintages are all sort of ending up above 10, sometimes 12, 13 transactions a month for the older vintages. But you see this trend also, it sort of goes towards the right for the vintages, but the pace is also increasing, and that is even more pronounced in the graph on the right, where you see for the later vintages, actually the pace of adoption of new use cases is increasing, and that pace adoption is largely a function of the fact that we simply have more use cases available to customers. You see the same kind of trends when you look at the average revenue per active customer. And just to point in the two graphs you see here, the scales are quite different. So on the left, you see that's just for our normal active customers, the revenue per active customer sort of starting at around 5 to 10 rand, but trending towards the sort of the mid-20s. But then we look at the customers who've adopted a second use case, such as buy now, pay later, or our salary advance, our paid wage program product. And there you can see, I think, predictably, two things. You can see the numbers being much higher, but you can see the trend towards higher revenues for those customers for the newer vintages, accelerating from the old vintages. And this is really what we need to see in the business. This trend of both increasing customer numbers, but more importantly, increasing adoption by customers. And this really brings us to sort of just a few of what it looks like at the results level. So for sort of the typical things we'd look at, so you have that 2.5 time customer base increase since June 2020, but you've got a sort of a 9 times annualized net operating income increase. This is just from fee income in the business. And that's really sort of driven by sort of the first one and the last one, which is the sort of the number of transactions increase on the platform, which is now sitting at over 14 million transactions per month on the platform. Now, the big question that then arises from it, if you're growing at that pace, can you maintain your cost base, and can you actually sort of get the leverage in the business that one would expect from a digital business? And this slide simply illustrates that we've been able to keep our operating costs through this time flat while exponentially growing our customer numbers and activity on the platform. And, you know, this is the thing I think we obsess about, is our ability to continue to keep that cost base flat and not to fall into the temptation of throwing humans at our problems, but doggedly automating as we grow. Just a quick, so that's really, Warwick, the story about on in-country expansion. Maybe just a few comments on cross-country expansion. And the question that people often ask me is sort of, how do you decide which country to go to next? And it's really a function of 3 things: a progressive regulatory environment, strong demographics in the market, and strong economics in the banking system, and then finding the right local partners. Our model is very much a partner-driven model. I think one way that we think about our model is simply we run a very low-cost banking model, and we share that economic upside of the low-cost model with our shareholders, with our customers, but also with our partners, so that one sort of creates that strong sort of ecosystem play that one needs in order to make a digital play like ours successful. So just maybe we can come back to this if people are interested. A few comments about the Philippines. We're very lucky in the Philippines that we found the JG Summit Group there as our partners. They essentially give us an entire ecosystem on a plate that it took us years in South Africa through different negotiations to establish. They the third largest family conglomerate in the Philippines, the leaders in retail, and what they give us is essentially not only a ready-made retail ecosystem, but also a very strong loyalty and customer database with rich data. So I'll just point to two things here. It's the 4,000 supermarkets that they have. As you know, we in South Africa, we've sort of deployed through the Pick n Pay and Boxer supermarkets, which is about a third of that in size. And then the other is the 8 million loyalty customers that they have. That includes the loyalty program of the low-cost carrier in the Philippines, Cebu Pacific, where the Kokongwe family are partners. Just as a point of interest, you see the word, the name in the Philippines is TymeBank. The reason is that the Kokongwe family, most of what they do in the market has the Go prefix. So they've got Go rewards, and all sorts of other things with Go in front, and TymeBank is therefore the name we've picked for that market. And the job then going to market 2 and market 3 is to actually get these economies of scale. And what we show on this slide is just benchmarking against the index of 1 in South Africa, the savings we get in building the second bank, which is 30% savings, and then sort of call it another sort of 15% savings from market 2 to market 3. And not only does one save money in terms of your development, but the job is also to get to break even faster. So in South Africa, we'll break even about 4 years from launch, but the job in the Philippines is to get it down to 3 years, in Pakistan under 3 years. The other aspect of course, is reducing the risk of building a digital bank, simply through experience, knowing and having the muscle memory of building new banks. Just a little bit about revenues. In South Africa, we very dependent in the early stage on transactional banking and savings revenues, which includes value-added services. And so all the green there you see is transactional banking and savings. The inner circle is 2020, financial year 20, which was our first full financial year. The outer circle is what we look like in our break-even year. And you see the yellow there, lending, the pink insurance, and the blue, which is our sort of a B2B product coming in. And what you see on the right in GoTime is that we can go in the second market to more products, to product variety faster than in the first market. And we bring in there what we haven't done in South Africa, and we see a great opportunity there, a strong element of investments, fractional share trading and crypto trading as part of the proposition much earlier than we're doing in South Africa. Pakistan, I'm not going to spend a lot of time on, other than to say that, you know, Philippines is about twice the market opportunity than South Africa, and Pakistan is more than twice the market opportunity that we have in the Philippines. Good margins in that market, and as you can see from the numbers on the right, significant market opportunity. Last is just to talk a little bit about how we're benchmarking against peers in the world. So we've just took here, we think are the most well-known household brands in digital banking: a new bank, Chime, Revolut, N26, Monzo, Starling. Of course, we're the youngest of all of these players. I think the nice thing from the perspective of people who are watching this industry is that slowly but surely the lights are coming on in the stadium. People are starting to see benchmarks. They're starting to see sort of where people are compared to each other. And all of us, our nerdy sides, get very excited when we can start going, how do we actually compare with the best of breed players in the market? And I think in many respects for us, we do see Nubank as a best of breed player, and very similar to us in many respects in terms of how they think about banking and the markets in which they operate. I think where we think we've benchmarked quite well is how much we've invested per customer that we've onboarded to date, and we're still not at scale yet, so that number will be coming down as we get scale, and I think that's sort of the important benchmark for us. We have, unlike some of the other digital banks, we do not have patient shareholders who want to wait a long time, and that includes the management shareholders who want to wait a long time until we see profitability. So making sure that we benchmark well in terms of our efficiency in using our capital to profitability is important. Some of you might know this, but just to recap, our shareholders, our controlling shareholder remains African Rainbow Capital, the listed entity of Patrice Motsepe investment entity, and then with our other big investors other than the founders are Apis, they're an impact investor from London, Tencent, CDC, which is now the British International Investment, BII, and we will be sort of starting a Series C. This is at the end of our Series B capital raise. We will be sort of launching into a Series C capital raise towards the end of the year, with a view to closing sort of end of first quarter next year with our Series C raise. Warwick, I hope that was helpful and not too boring. I'm happy to take questions and hear comments.
Great. Thank you. That was very informative, and I have no doubt that's raised quite a few questions. The first one that comes to mind is just trying to get an understanding of where you compare from a business and strategy perspective to some of those peers that you've just listed globally. As you say, Nubank probably one of the best in class in your category. But what I would note is that their business models are quite structured towards lending. You know, that seems to be the ultimate goal. And I just want to get a sense, do you feel that your business can be sustainable without materially increasing your unsecured lending strategy?
Yeah, I think it's correct to point out that they're very lending orientated. You know, like Tinkoff Bank, sadly, has sort of going through tough times in Russia. They were credit card led in their model. And that has been a very successful model for them. You know, we've been convinced from the start that being transactional led, transactional and savings led, is the right model, both initially from a risk perspective through the cycle, that you're actually building a low cost business, a business that is not in the early days as exposed to the market cycle as a lending business, but also from the perspective of building a very disciplined, low-cost business. So I think the first question is, can we build a sustainable business without lending? The answer is yes. So transactional banking in itself is a profitable business for us. We make money even from a SASSA grant recipient in South Africa, a COVID grant recipient who only gets 350 Rand a month. That customer is profitable for us. With a payback period of sort of 6 to 8 months, depending on the customer's behavior. But we will never be, in terms of return on equity, we will never really compete with those banks until we do lending at scale. And so, although we're not lending-led, lending is an important aspect of our business, and we will be looking in the coming years to accelerate lending in the business substantially.
Interesting, thank you. Let's go to David Rousseau. Go ahead, David.
Thanks for the opportunity and the presentation, Kunrad. Um, just you might be a bit pivoted more towards informal market. So maybe you can maybe share if that's true and if that's the main client and what sort of trends, how big do you think the market is? Just maybe in South Africa, 1 or 2 points from that perspective. And yeah, just maybe how does the profitability change over the medium to long term from that client perspective? I think you're talking about lending. How do you compete with a Capitec?
Yeah, David, I'm tempted to dive into a lot of detail on our segment strategy. Let me try and keep it high level. We actually have five segments that we serve, and one of them is what you refer to as the informal market, sort of your typical social grant recipient or informal micro entrepreneur, business person. And the main channels that we use for those customers are our Boxer stores. We are deployed in SASA offices as well as through the ZCC. So that segment is an important segment. They are profitable for us. We'll never get, our shareholders will never get super rich out of them. But we think that they're important for the network effects of the model and sort of to build a business at scale. That's a big market. That's an addressable market of 22 million grant recipients. And getting a significant portion of that market for us is a good and profitable business. But it's not a market that you can cross-sell lending products to really. You can cross-sell a bit of insurance to them. So it will always be a high volume, low margin segment. Then the second segment, our lifestyle segment, is really sort of looking at the shopper in the family. And this is the segment we actually sort of focusing on through our partnership with the Foschini Group and through our partnership with Pick n Pay. And what we're focusing on that segment, we're really focusing on buy now, pay later, loyalty, and credit cards as the sort of hero products in that segment. That's a much smaller but more profitable segment. So I think sort of the addressable market there is maybe closer to 10 or 12 million customers that would be falling in our sweet spot within that segment. The third segment is really sort of what we call workplace banking, and that's looking at the customer who is the breadwinner and sort of helping them with their sort of financial wellness needs through partnership with employers in the workplace. And the hero product there is our earned wage product, time advance, that allows you to draw down on your salary in the course of the month. The fourth segment is like proper digital natives. We talk about cyber banking. So those are your gamers, crypto traders, the NFT, the non-fungible token crowd, the fractional share traders. That's sort of the segment that digital banks have done well in the past at. They're a relatively small segment for us at the moment. We've got about maybe somewhere around 48,000 active customers, but they're very profitable and they're very enthusiastic segment. And there's a lot more to be done to build out our proposition for that segment. And then the last segment are really owner managers. So people who run relatively simple businesses, owner managed businesses, and we've got about 100,000 of them on the platform. So I think one of the things that the perceptions about us is that we sort of a bank for the poorest of the poor in South Africa, and that is correct but incomplete. I think that's where we started, but that is certainly not where our ambition is to play in the years to come.
Okay. No, I'm actually a client, so a secondary account I have with you.
I'm happy to hear that, David. When I talked about the crypto nerds, I saw you smiling. So I thought you might be one of that segment.
Yeah, but just maybe a follow-up. It seems like the informal you segregating the grant recipients to maybe a more informal entrepreneur. How big is that market and how resilient has that been in COVID? Maybe you've got extra insights, I'm sure. Just one or two
Yeah,
comments. Great, thanks.
yeah. Listen, it's been fascinating to watch, and of course, there's a lot of noise in the data. One thing we know from studying sort of informal entrepreneurs is that often that segment is more resilient than you would expect. And we saw that, for instance, one of the banks we've learned about a lot over the years is Bank Rakyat Indonesia, which is the sort of the de facto leader in SME banking in Indonesia. And through the Asian crisis, they were the only bank who actually suffered very few credit losses and actually came through quite resiliently. So I would not say that our so first, how many customers in that segment? 1.5 million small businesses and growing. So it's a good big segment, and it's a growing segment. The segment in there that's very interesting for us is what we call social sellers. So those are people who sell things either that they make or that they trade on Facebook and other social media sites. And that's a very interesting, that's hundreds of thousands of South Africans doing that. It's one of those segments that I just don't get. You know, you go on Facebook and, you know, you go buy from other people on Facebook, you buy things, but it's a massive market. And so our numbers, I don't think our sort of numbers are big enough to make strong conclusions about how that market is done through COVID, other than to say that although the month-to-month churn is high, the category has been quite, or the segment has been quite, as a segment, resilient. But there's been a lot of individuals cycling in and out of that segment on a month-to-month basis in terms of activity levels. But we think it's a segment in South Africa with very strong potential, provided you can actually give them the proposition that they need. And particularly the social sellers, they need a proposition very similar to the one that Alibaba and Tencent did as their hero products initially in China, which is just the ability to sell something to somebody, get it delivered to them, have an escrow account where the money is held back until the delivery is successful, and then release the money back. These aren't very complicated propositions, but pitching them in the right way to the segment is going to be key in unlocking the success of the segment. The other thing I'll mention, that we think that in this segment, credit is critical, and there are only a few people who get that right. So that's a whole conversation for another day. But getting a credit extension, unsecured credit extension, right to the informal or the semi-formal trading segment, whoever actually succeeds there has a huge opportunity on their hands.
Fantastic, thank you, Kunal.
Thanks for the question, David. Let's go to Donata Sibanda from MIBFA. Go ahead, Donata.
Good afternoon. I just have 3 quick ones. The first one is with regards to NetBank. NetBank is busy rolling out something similar to what you guys already have, like a system that enables customers to be able to apply for a new account and open a new account and get a new card instantly. So because I think they will be the second bank to do that after you guys. So do you think that can be a threat to you, to your business? Because if there is one thing that consumers, the general consumers liked, or the potential customers liked about your bank, was the ease of opening up a new account. So if another bank or if other banks start to follow up on that, how, like, what negative impact or the extent of the negative impact can that be on you guys writing new business in terms of new customers? And then the second question is just on the, I think, like David, I'm also one of your clients or your customers. I noticed something. They I think beginning of the year you started charging some, I think it's 30 cents for SMS notifications, of which she never used to do before. So I'm just trying to understand if that was part of the plan, or was it because of maybe some or some pressures that you've been seeing, and then you now try and find opportunities or pockets where you can start to charge small fees here and there to subsidize the cost that you have. Or yeah. And then the third one is just on the going concern. I think it was on your 2021 financials. The audit report, that was one of the audit matters was around the going concern that it's uncertain. The only time, I think one of the supports was that you can only maintain, your business can only maintain your going concern if they continue to get the share or the key shareholder support, financial support beyond October 2022 is what was written in there. So I just want to understand if there's been any changes that you've noted in there, or what kind of financial support are you expecting going forward? Do you think the key shareholders are still keen to keep on supporting this business up until break-even point and beyond that? Or is there something that we need to be worried about or be concerned about around that?
Thanks, Donata. You are putting me through my paces. All three of them are quite challenging questions. But let me start with the last one first, and in a way that's the easiest, which is that we actually, in our Series B capital raise, we actually raised enough capital to actually see the South African bank through to break even with some margin for error. So we're well capitalized now to get past break even. With, I can say, strong support from current shareholders, as well as significant interest from other investors in the market to invest in us. So I think capital was quite hard through that first year of COVID, getting that capital. But we're now at a point for TymeBank where we're not concerned from a capital perspective. We're in a strong position. On the question of fees, so I'll take your questions in reverse order. On the SMS fees, what we're really trying to do there is to drive our customers to the app rather than using web and other channels, because once you have the app, your in-app notifications and your app-based notifications are actually zero rated, and enables us to actually engage with, give you a much richer engagement. So the 30 cents was really primarily a behavioral driver to try and put a little bit of friction and convince customers who are very cost conscious to actually go for the app experience rather than for the normal web experience or continuing to use SMSs. So as a customer, what you should do is to disable SMSs and just use in-app notifications. But thank you for being a customer and for noting those things. I think it is actually really important that we're able to justify and to explain these price changes that we do bring into the market. But largely, we see price changes as just one of the behavioral nudging aspects that we can use to sort of create the right kind of customer experience. Then on the Nedbank thing, I actually haven't seen, I don't know whether they've launched it yet, but I haven't seen the new bank account opening process. We've been actually surprised at how long it's taken customers to, or rather our competitors, to come up with a fully digitized, fast account opening process. We think it's more and more technology makes it easier and easier to do now. But I would say that it's not just a function of how long it takes you to open an account. It's also about what that experience is like and what channels you use to mobilize that experience. So do you, for instance, the role of the kiosk is very key in that experience. Now, ABSA has also now launched the kiosk. We're very interested to see how that kiosk performs. And so we're watching that carefully. But our job is to get ahead of that. So we are already working on a new account opening experience that's hopefully even lighter and more cost efficient than the one we have now. And that's the job, is to just stay ahead of the competitors, who, by the way, we take very seriously, and particularly the big banks, as you all know, they're very sophisticated, they're formidable competitors. And so we never take the position we have now in the market for granted.
Thanks for the good questions, Donata. I've got a couple in the chat. I'm going to start with the most recent. It's a very simple one. Just what percentage of customers fully convert to TymeBank from other banks, i.e. kind of receive their salaries into your bank account?
Yeah, that is actually still a small percentage. So, I would say in terms of proper primary banker customers, that's still less than 3% of our onboarded customers that are primary banker customers. And there's sort of 2 points to be made on it. The first is, we don't need a customer to be a primary banker customer to be a profitable customer for us. So the bank is built in such a way that it actually works if people like David and others have the account as a sort of a secondary account, as long as they have 1 or 2 use cases that they use it actively for. Having said that, we do want to become a primary banker. We're finding the process of somebody moving their salary to us is not a overnight process. It is a long process of building trust. When we ask people in focus groups, what are the things that you can tell us about TymeBank? How do you see TymeBank? Even 3 years after launch, the thing that comes up consistently is, you're a new bank. And so we're seeing that process of actually getting primary customers is a long process. And partly it's a matter of functionality. So there's some functionality richness that we didn't have in our account, that particularly middle class and mass affluent customers do want to see before they will move a primary account. And then we think lending is key. We do think that we won't build a significant primary account base until we've settled our unsecured term loan proposition properly in the market.
Conrad, there's a question from Damon. He's asking about how you leverage loyalty membership base of the retailers. Maybe you can just explain that and how the economic benefits are shared between Time and the retailer.
Yeah, that's again a very good question. So we, from day one, we were integrated into Pick n Pay's Smart Shopper program, which, as you know, is often sort of in the one, and either the number 1 or number 2 or number 3, a Smart Shopper loyalty program in the country in terms of popularity with customers. The way we do it is we essentially put the Smart Shopper program on steroids for customers. So when you open a TymeBank account, if you are already a Smart Shopper member, there's an automatic link in the back. So your TymeBank your debit card becomes also a loyalty card that can be used for your loyalty. If you're not already a member, you automatically become a member. And that's true even for the customers we'll be signing up in the Foschini group, and customers will be signing up in the ZCC channel. So all our customers are also Smart Shopper customers. And then what we do is we give them double Smart Shopper points. Those points we actually buy from Pick n Pay, but at a discount to the face value. But we actually buy those points from Pick n Pay, and we use the merchant discount, the interchange, to pay for that, similar to what other banks do. People also earn Smart Shopper points outside of Pick n Pay stores when they use our card. In Boxer, we've got a different strategy. It's more of a specials and discounts kind of strategy, where we link into the Boxer.com, their own virtual SIM proposition. So that's a different approach. And I'm not going to do a spoiler on what we're doing with TFG. You'll see as we roll out what we're going to be doing there.
And then just 2 very quick ones here in the chat. Are all your kiosks manned?
No, but that again is a very interesting question, because we have a big debate about this and the customer experience and cost efficiency trade-offs of manning and not manning kiosks. I think initially we thought we could man them for a while and then leave it to the store staff inside Pick n Pay and Boxer and our other partners to do it. But we do see that there's a customer experience degradation from not manning a kiosk. And so currently we don't have them all manned, but it's a live debate in the business. You know, how often should one man them, and to what extent should they be manned, in the interest of creating a more consistent and rounded customer experience.
And then, are you on the Apple App Store yet?
Yes, we are. So I think that might have been asked by somebody who went there and didn't find us before. We are. Our Apple app is not as rich and as fun as our Android app, because the bulk of by far our most popular channel is the Android channel. But I'm an Apple user, so I'm one of those guys who are sort of pushing the team to get that Apple experience improved. So I think to give you a sense, I think our Android app scores about 4.5 out of 5 in the store, whereas our Apple is 3.7 or 3.8. So it's not as good as the Android app.
And then a very last one from my side, just your buy now, pay later product. I guess, as you say, you're launching it with Foschini, but you've already got more time. Is all the credit risk sitting on your balance sheet?
Yes.
Okay, including the Foschini relationship, it'll be the same. It's going to be kind of your risk, and the merchant discount rate will compensate you for that.
Exactly. Yeah. So that is so our credit card is off balance sheet. That is on the RCS balance sheet with BNP Paribas sort of backing there. But buy now, pay later, and our salary advance product are both on our balance sheet.
Okay, I think it's been a fascinating conversation. Unfortunately, we're out of time. I would love to continue, but I'm going to hand it back to you, Conrad, for any kind of closing remarks.
Yeah, thank you very much for the great questions. Building a new digital bank is always a work in progress. It's never as perfect as we want, but it's a great adventure, and look forward to continuing any conversations if anyone's interested. Thank
much
you,
appreciated. Thank you very much for the time, and thanks for the great questions, everybody. Enjoy the rest of the day.
Thank you. Bye-bye.
Thank you.
Thank you.
Bye-bye.